So you said not too long ago that when the 10-year yield nears 3%, we've got to start worrying. You were right, because what happened at the end of January, February was evidence of that. We've moved on since there. We're in another period of volatility. How do you read the markets right now?
Well, we were quite cautious at the time on, the market. As we talked about a correction, but we also talked about earnings. And I recall we talked about, the fastest growth in terms of analyst expectations for Q1, which was up 5.5%. I mean, that's the highest that's been since 2002. They usually go down. So you've got actually an underpinning of very strong earnings coming up in the US, which is because of tax cuts. That's not only going to be, I think, about 5 to 7% this year in the quarter, but it's going to be even higher than that, maybe 12, 13 now with tax cuts. But you're looking at 20% EPS growth this year. So, that's a big reason to own US stocks.
So you were brave enough to put forward the notion that a correction might be due, and you were right. Yeah. Are you suggesting the opposite?
Well,
might happen? Could we retrace the losses, 8, 9%, whatever it is?
Yes, but as always, these are the late stages of a bull market, and you've got to be positioned in the right areas. We talked about being cautious on tech and being in the value sectors. So I think, yes, with the caveat that at some stage you are going to get rising inflation, rising interest rates, to my point about 3%. And that's going to spook markets, and that's going to put the Fed behind the curve, and then you're going to get worries, and that's why we talked about maybe actually looking at the REITs, the utilities, the staples. I think that's some ways off, and I still think the equity market's going to be quite strong, but you have to pick your spots would be my advice.
But Patrick, the Fed has optionality, right? So it doesn't ever have to be completely behind the curve. It can always move quickly or move by a double interest rate increase, a 50 basis point move, if it really does see that it's behind the curve.
Yes, but it's, as always, Vonnie, equity markets are driven by earnings, and it's that rate of change that people pay for. And if you're going to get 50 basis points, to your point, then that would really hurt the momentum stocks. And generally what happens in equity markets is that the value stocks, the cyclical stocks, will always outperform in the later stages of an economic expansion. And to your point, the only reason interest rates would be rising that dramatically would be because the underlying market's actually quite strong. So once again, I would reiterate the value stocks, and we particularly like, the oil shares, which we talked about, the financials, and even some of the consumer discretionaries. So as I say, you've got to pick your spots.